When it comes to finding the correct contract to buy, you need to go over a few things before. Actually, let's do Apple. You'll need to go over a few things before you start looking at contracts, and that would be, um, what are your intentions with the stock? What is your plan? So, if you're going to be day trading it, then you can go for a weekly expire. You can go for even a 0 day expire. If you're going to be swinging it, ideally, you'll want to go further out. So let's bring up Apple. So let's say Apple you think is going to be 130, and you're going to swing it. So you're not going to go for a weekly just because if you were to buy this tomorrow, that means you only have tomorrow and then you have 5 days after that for this to go in the money. Now, if you were to buy, and that's why they're so cheap is because the likelihood of this 130 getting hit is not very probable. So if you were to go for the 126 or the 127, um, you do have a theta here of, 10% of the contract. So every day that passes, your contract is losing 10% of its value, more than 10% of its value. This would be losing $8. Um, and so, really, what I do is if I'm day trading, then I go for, if I'm day trading on Mondays and Tuesdays, I will go for a weekly expire. If I'm day trading anything after that, so Monday, Thursday, or Wednesday, Thursday, Friday, then I go for the following week expire. So what that does is, yes, the contracts are a little bit more expensive, but they're a little bit safer as well. They're not going to be as volatile, and you're not going to have to worry about taking, like having 2 hours of just stagnant movement, and the stock is not moving that much. You don't have to worry then about your contract just kind of eating itself away, and now you have to wait for an even larger move for you to just break even. So this kind of eliminates that. Now, if you're going to be swinging a contract, you're going to want to go for specific expires. So right now, if you were to swing something, it would be June 18th. That's the date that you want. Now, the third Friday of every month is the most popular options date. So it's going to be the most liquid. So we're on June 18th. Let's go to the 130s. So the 130s have a $25,000 or a 25,000 volume, 105,000 open interest. Now I bet you if we go to June 11th, look, 2,700 open interest up compared to 105,000. We'll go 1 week ahead of that, and these will. Okay, I'm not sure what that was. That was for the 130. What is going on here? Okay, 7,000. So the June 18th have more than 10 times the amount of open interest than anything else. So then the following one would be July 16th. If you're going for a longer swing, you're going to be going for July 16th because again, that is that third Friday. So let's compare it. 135, 88,000 open interest. The 130 has 57,000 open interest. So much more than the previous months or the previous weeks, aside from that June 18th. And then you can see here, it just starts giving you automatically those third Friday expires. So when you're swinging, go for the third Fridays because you're going to get more liquidity. Go for round numbers. Go for 140s. Go for 145s. Don't go for these weird strikes. Don't go for like a 128. Don't go for a 127, whatever it is. Go for round numbers and go for the third Friday. That's the contract that everybody is going to automatically go for. When people are thinking, if there was a breakout that's going to be happening, people are speculating there's going to be a breakout and they think Apple's going to hit, 150, or people are going to think Apple is going to hit 147. People are going to grab the 145s, they're going to grab the 150s. Even when these get closer and closer to the money, people are still going to be grabbing these round numbers. That's just kind of what we do. It's natural to kind of be attracted to those round numbers. So make sure that you are getting contracts that are close to the money when you're day trading. Weekly expire on Monday and Tuesdays, and then further out contracts if it's anything past Tuesday, and that's kind of when you're starting out. It doesn't always have to be that way, but it is much safer to do so. Make sure that you can lose the amount that you're kind of investing, just because options are extremely risky, and so just make sure that you can lose it, because Tesla, let's say you paid 15 or yeah 14.50 for this 635 contract, and Tesla moves from 629 up to 632. Now this contract is going to be worth $1,600. So you just made $200, but you don't sell it, and then Tesla goes back down to where it is. Well, this contract is not just going to go back down to where it was when you first bought it, even though the stock did. This is going to go down to $1,300, $1,200. So you're just going to need a bigger move from Tesla to kind of let you break even. So it might have to go up to 634, almost putting this contract in the money for you to make your money back. Contracts are wild with their values. So make sure that you are prepared to kind of risk the amount that you're putting in there. And if you are not, you need to have strict stop losses. So when it comes to choosing the contracts, make sure that you can afford it as well. And averaging down on options rarely works, I would say. You're better off by selling. If you're really down bad on like a weekly expire, you should sell that contract, take the loss, take that money and roll it into a further contract. Roll it into like a further out contract. Even if you are going further out of the money, just give yourself that extra bit of time for the stock to kind of do what it needs to do. Options are pretty tricky. So if you guys have any questions on this, or you are struggling with finding the right contract, please let me know. I'm happy to help you guys out. These are just the few things that I look for. Close to the money when you're day trading, and then when you're swing trading, make sure that they are close to the breakout price that you're looking for. Or if you have like a target on Apple of 150, grab a 140 strike. Give yourself that room for you to be wrong. That's the key point with options, is you always are giving yourself enough room to be incorrect about what you're kind of expecting. So just try that out. Try the Monday, Tuesday weekly expire thing, and then everything after that going for the next week, and you'll notice a huge difference in your losses. They'll shrink. So that's the most important thing in my opinion.